Investors, after a week worth of market momentum winding down and inflation coming in above 3%, we should all be looking for hints and clues as to what the Federal Reserve may do come the September FOMC meeting. But more on all of the macros to come. If you're new here, I'm Ari, a dividend investor here on YouTube, sharing all the economic insights that you need to know about, and of course, new dividend stock ideas on a week-to-week basis to drive more profits your way. Now, as for today, that is exactly what I have in store for you. So without further ado, let's dive right in. So as mentioned, the market has been losing momentum, especially with most companies now having reported their earnings and investors realizing that our economic environment hasn't changed much, which then, to no surprise, my personal account trickled down to $121,326.93, which is down by about 2 to 3% from its peak just a week or so ago. Now, usually I speak about what happened to trigger the decline, but this week I think it's pretty simple. The concluding days of earnings season, when our economic reality again hits investors square in the face, and we're once again realizing that we're not in a new bull market. And likely for those investors out there with a little bit more experience, a lot of concern over Moody's recently cutting credit ratings of multiple US banks, like the Mellon, US Bancorp, and Northern Trust, signaling liquidity implications and a potential for future financial sector risks, which would then spill into other sectors. But that aside, we also just got a fresh new inflationary reading depicting July's consumer price index popping up slightly here to 3.2%, which in my opinion is going to trigger the unexpected but very well should be expected Federal Reserve chess move of at least one more interest rate hike. Now, I could be very wrong, but whether or not that's the case will not negate the fact that we're going to be in an environment that really is not going to be ideal for businesses nor consumers like you and I. So yes, this is another warning to proceed very cautiously when investing, at least in knowing that more economic uncertainty is likely and lies ahead of us, and we could very well see another shakeup, perhaps not a recession, but I'd like to believe a 5 to 15% correction by the year's end.
We remain constructive on the equity markets in the long term, but we do think that in the short term, the market is poised for a correction because seasonally, September is one of the weakest months of the year in the stock markets. And the S&P 500 has just had the best first 7 months of the year since 1997. So a correction is definitely on the cards.
And I've been talking about this the last couple of times on the show, is, August to October, I have a little bit of fear we have a pullback. And I don't think it's going to derail the overall rally. I think we could finish the year at record highs. But I want to be prepared for that pullback. I've trimmed a little bit and kind of get ready for that.
So we obviously impressive strength since the October 14th low of last autumn, which is in many ways almost as impressive as the preceding sell-off. We know that global equities peaked on 4 January 2022, and S&P drops 27%, NASDAQ 100 drops 37%, and then since that October low, we've been recovering. But the market, as in any instance, whether you're going up or down, is always characterized, or most always characterized, by counter trend moves. So on the way down, that 27% decline, we had these very important counter trend moves, these sharp rallies, which gave way to new lows. Well, so too, from the low of October 14th to where we are now, we have had two very distinct counter trend moves, sell-offs.
But as always, dividend investors like you and I can use times of volatility to our advantage, and until then, we have opportunities out there, 5 of which I have for you today, which all leads me to the very first dividend stock that I want to discuss. It's Texas Instruments, ticker symbol TXN, which is one of the global semiconductor manufacturers out there, which has seen a nice run up over the last several months, but recently, following a beat on earnings, shed light onto rather nil guidance, and given the economic outlook that I just mentioned, I think we're looking at some weaker demand here. Some analysts have then been downgrading it, leading to a share price that has been sliding, currently trading for $167 per share. That's down from a peak of around $185 per share not long ago, with a PE ratio currently coming in at 20. Now, I'm mentioning Texas Instruments because this one isn't necessarily a buy right now, but I think it's well worth adding to your watch list should it continue to slide. After all, there are still many analysts out there still predicting upside here, coming up to a share price of $185.51 per share. Meanwhile, hedge funds continue to see its future potential and they're buying more shares worth of the stock. Now, until it rebounds, we're all going to be able to enjoy its dividend yield coming in at 2.94%. Now, before I get to the next dividend stock, investors, I want to ask for your help directly because believe it or not, the more that thumbs up button is clicked by all of you, the more YouTube recommends this video to other viewers. So help me grow this channel by tapping on that thumbs up button. And of course, if you're not already subscribed, subscribe now to never miss a single video. With that, let's get back to it here with Consolidated Electric, or Con Ed for short, ticker symbol ED, which is a utility company that really only provides electric power services to New York City and the surrounding area. But you can't underestimate the power of Con Ed, as they're serving well over 10 million customers. And now I'm going to let you in on a little secret, because if you aren't from New York City, you wouldn't know this, but Con Ed is actually the only service provider within the borough, so literally a monopoly, and one that remains reliable for all of us dividend investors, which means when it comes down to investing into Con Edison for the longer term hold at the right price, it's certainly a buy. Now, Con Ed right now is down by roughly 3.3%, trading for $90 a share, with a PE ratio coming in at just 13.1. And I'd like to believe that that is solely because investors are trying to jump in on the profit train out of earnings season. But it's likely going to be rebounding in the midst of all the volatility that's expected, given how safe it is, with a rock-solid dividend coming in much higher than the sector average here at 3.51%. Coming up to our third dividend stock, let's talk about a rather less spoken about advertising gem. It's Interpublic Group of Companies, ticker symbol IPG, which is focused solely on marketing and advertising specific to consumer products, while also remaining the parent company to several agencies within the industry. Now, with higher interest rates coupled with a challenging market environment, likely ad budgets are usually the first to go, to which we're seeing a share price now at $33 per share after just hitting $40 per share within the last couple of weeks, along with the PE ratio now at 13.8. And that's all I can say is that an economic reality always kicks back in after the most exciting earnings reports. And when all is said and done, there's always going to be another bull market coming our way, which means this is a great buy and hold opportunity, especially when analysts are projecting upside coming up to $39 per share. That's roughly 17% worth of upside. And until then, as a shareholder of Interpublic Group, you're going to be enjoying a dividend coming in at 3.6%. Next up, I want to go back into a healthcare opportunity that I recently mentioned, but one that just remains way too good to pass up. It's with Bristol Myers Squibb, ticker symbol BMY, which is one of the world's largest pharmaceutical companies. So, need I say any more? Well, perhaps so, as Bristol Myers now recently announced a share buyback program, announcing that they're going to buy back about $4 billion worth of shares, which will all do wonders in terms of value for shareholders and presenting then a nice opportunity when we see that share price sliding as it is right now at just $60 per share at a PE ratio at 15. But investors, check this out. Analysts are projecting over 16% worth of upside, coming up to a share price of $70.91 per share. And yes, you can believe that smart money is also all over Bristol Myers right now, as hedge funds have been increasing their holdings by over 116,000 shares last quarter. Now, until Bristol Myers is back on the up and up, we can reap the benefit of being a dividend investor with this dividend coming in at a dividend yield of 3.72%. And last but not least, our biggest dividend payer on the day, T. Rowe Price, ticker symbol TROW, which is a global investment management firm that offers funds and retirement planning for individuals, institutions, and financial intermediaries. Now, when it comes to T. Rowe Price as an investor, here's what you need to know. The vast majority of their assets are tied up in the NASDAQ. So when tech shoots up, T. Rowe Price does better on the books. Now when tech sells off, well, T. Rowe Price follows suit. So we shouldn't be too surprised here in seeing that their share price is now down to $113 per share and likely may continue to slide further, along with this PE ratio currently sitting back down below 20 at 17.1, triggering hedge funds to move in while they can with T. Rowe Price, as we can see holdings have increased by over 24,000 shares last quarter. But if you want to know my brutal, honest opinion when it comes to T. Rowe Price, I think this is a great long-term hold, well into a real economic recovery and bull run, especially when T. Rowe Price has a dividend yield coming in above 4% at 4.15%. Now investors, Those are the 5 dividend stocks that I have for you today. Let me know what you think, or if you have better dividend stocks in mind, by commenting down below. And for your own sake, I made it incredibly easy for you to find the next video. Just click right here to get to it. Now before you do, tap on that thumbs up button and of course subscribe to never miss a single video.